Short exercise 2-5, we're going to record transactions in the journal. So Harper Sales Consultants completed the following transactions during the latter part of January. Latter just means towards the end. So we've got some transactions here, and if you ever wanted to print this out, you could, but there's probably no need to do it. Also, we've got the transaction information here, so we don't need that window. It says journalize the transactions of Harper Sales Consultants. Include an explanation with each journal entry. And then it's always going to remind you this. Record debits first. Always, always, always record debits first. Otherwise you'll get marked wrong. And by recording debits before credits, it makes the journal transaction much easier to read. So always record the debit account first, and then the credit account. And then it's reminding you select an explanation on the last line, which is right here. So here's the transaction. Notice they've already put the date in for us. Harper Sales Consultants, that's the company we work for, perform services for customers on account. So we performed a service, so that means we need to record revenue. And whenever we sell something, we're either going to get cash or we're going to record accounts receivable. Now notice it says for customers on account. So this means our customers are promising to pay us later. Therefore, we're not getting cash now, so we're getting accounts receivable. So, accounts receivable is what type of an account? It's an asset. And is our accounts receivable increasing or decreasing? It's increasing, so therefore, assets increase on the debit side. So we're going to record accounts receivable first. See if I can double click that. Nope. 7,500. I can copy and paste this. The credit is also $7,500. And why are we recording this accounts receivable? Because we perform services, so we have to record revenue. So revenue, do we have more revenue or less revenue? We have more revenue, therefore it's increasing, and revenue increases on the credit side. So that's why it's the credit account. Service revenue. And then we need an explanation. Let's see here, perform service for customers on account. Now there is something that's unrealistic about this. Notice nowhere does it say what the customers' names are. So if your boss ever came back to you and say, okay, well, which customers owe us this $7,500 in AR, you wouldn't be able to tell them. So in the real world and in future chapters, we will be recording the names whenever we sell something on account. All right, next transaction, January 30th. Harper Sales Consultants, that's us, received cash on account from customers. So we received cash, cha-ching. Cash is what type of an account? It's an asset. And if assets are increasing, that's a debit. So I'm going to record $8,000 for cash as a debit. Remember, the cash is just a checking account. And then, so why did we receive cash? Because we received it on account, which means the customers are paying off some of their accounts receivable. So up here, we increase the accounts receivable by $7,500. And now customers are paying off some of that, $7,500. In fact, they're paying off more, so there must have been more in that account prior to this. So we need to lower accounts receivable. And notice we increased it up here with a debit. Therefore, to decrease accounts receivable, it must be a credit. And if you look at the accounting grid, accounts receivable does decrease with a credit. So remember, when a customer pays us off, we have to lower their accounts receivable. And let's see here, the explanation is received cash on account from customers. Fantastic. Next, January 31st, Harper Sales Consultants, that's us, received a utility bill, $220, which will be paid during February. So notice it's January. We're going to pay it in February, so we're not paying it now. So this is some type of a payable. But let's first talk about, well, what is the expense for? It's a utility expense. So let's see if they have a utility expense account. And utility expense is an expense, obviously. Do we have more expense or less expense? We have more. And how do expenses increase? Debit or credit? They increase on a debit. All right, now let's look at our chart of accounts, which is right here. How many payables we got? We got accounts payable, but now this problem, you have to be really careful. This company has chosen to have a utilities payable. So which is more appropriate? Accounts payable, which is what most companies would use, to be honest with you, or do they use a more specific utilities payable? So we have to use utilities payable because that's what this is for, utilities. So what kind of account is utilities payable? It's a liability. And is this liability increasing or decreasing? It's increasing. And how do liabilities increase? On the credit side. So the explanation, received a utility bill and we'll pay it in February. January 31st, Harper Sales Consultants paid monthly salary to the salespeople, $2,500. So I'm going to put the $2,500 in there now. 2,500. And so we know cash is involved because this is paid. So let's talk about cash. Cash is an asset, and since we paid, cash is going down. So since cash is an asset, how do assets go down? With a credit. So I can't put cash first because the debit goes first. So I'm going to put cash on the second line as a credit. Why am I doing that? Because remember up here, record debits first, then credits. All right, so now we've got to figure out what's the debit account. So why are we paying these people? Because they're our sales people. So let's see if we have like a salary expense or something like that. There you go, salaries expense. And why is this expense being debited? Well, first of all, is this expense, salaries expense, is it increasing or decreasing? It's increasing. And how do expenses increase? With a debit. And then we look at we have to enter our explanation, paid monthly, salary to salesman. Next, Harper Sales Consultants, that's us, received $23.10. All right, so it says received $23.10, so we know cash is involved. Which way is cash going? It's going up. And if cash is an asset, so if cash is going up, it's a debit or credit. That's a debit, so I'm going to put cash as a debit account. And then we know the other account has to be a credit. Let's see, so why did we get paid? For 3 months. So we received the money for 3 months of consulting service. Now this is key. To be performed starting in February. Well, what date is it now? It's January. So we received this money, but we're not going to give them the service until the next month. So have we earned this? No, this is unearned revenue. Unearned revenue. And let's make sure that crediting it makes sense. So unearned revenue is what type of an account? Because it's unearned, it means we owe them this money. So the next day, these people could come back to us and say, well, okay, you still haven't performed the service. We just want our money back. So we owe them either the cash back or the service. So unearned revenue is a liability. So then we look at our accounting grid, and liabilities increase on the credit side. And of course, we have more liability now. It's increasing. So that's why we're crediting this liability. And then so the explanation is receive 3 months consulting services in advance. So remember, if you ever get paid for something, you have not given them the product or service now, that is a liability, and that's called unearned revenue. Next one, and the final one. Harper Sales Consultants, the owner, Damon Harper, withdrew $950 from the business. So we know cash is going down. So cash is an asset. And how do assets go down? With a credit. So I'm going to credit cash. And again, I'm putting it on the second line because credits have to be listed after the debit. So what's the debit account? Well, why is he taking money out? It's a withdrawal. And he has more withdrawals. And then let's look at the accounting grid. How do withdrawals increase? They increase with a debit. So that's why we're debiting withdrawals. So let's see here. Owner withdrawal. Check answer. Fantastic. And that's it.